Okay, welcome, ladies and gentlemen. It is Sunday, May 10. Good evening, good afternoon, and good morning, depending on which time zone you're in. Welcome to the third live stream webinar of the Finance Storyteller. Happy to have you on the webinar. We have the chat function enabled for you to ask questions later on. What I would like to do is to share with you that we've already had two prior webinars in recent weeks. The first one was around the financials, the earnings results around Netflix and Procter & Gamble. The second one was around Facebook and Apple. And today's webinar is around Uber Technologies. The replays for the previous webinars are still available in the members only section of the Finance Storyteller YouTube channel. And the easiest way to access it is to go through the community tab where the direct link is posted. So two companies in each of the prior webinars. Today only one company, but a company which has quite, let's say, complicated financial statements and a complicated structure to analyze. So it actually took me quite a bit of work to prepare for this, and hopefully I can provide you with some useful insights as to how to approach the quarterly results analysis. Because that is different for each company that you approach, but there are also some general lessons we can share on that one. So, Uber Technologies, let's get some context first, so that you have a little bit of the background around the company, and then we'll dive into the numbers. Today is exactly 1 year ago that Uber went public. Their IPO in May 2010, and the IPO price was $45. And this was the most discussed IPO of last year because it was one of the IPOs that on the first as well as the second day of trading had decreases in the share price. So that was a major disappointment for the company itself as well as the existing shareholders. And since then, Uber really hasn't recovered till the level of the initial issue price. It was at $32 yesterday, or rather Friday. It was at $15 at the bottom of the market so far in March 2020, and all throughout 2019 it's been going pretty much between $30 and $40. Obviously heavily impacted by COVID-19, just like with the other companies. The COVID epidemic in most countries gained its effect mostly in the last 3 weeks of March. So on a global, total world basis, let's see how it impacted Uber. And let's also see what they give in terms of guidance of the future. So let's go to their website. Investor.uber.com is the place to retrieve the data around financial presentations. And in the news tab, there is the link to the results. In the news tab is also the link to an announcement on April 16 that I'd like to look at first. Because on April 16th, much of the news that is in the earnings release in the numbers was already in some way or form announced. So this is the announcement of April 16. This is where the company announced the date of the conference call for the quarterly results, which is more an agenda type of announcement. It withdrew the guidance for the current year, which means that they no longer want to make any commitments or estimates around the financial results for 2020 for obvious reasons, right? Let's see where that it is impossible to predict with precision the pandemic's cumulative impact on our future financial results. So the numbers that they presented to the outside world on February 6, 2020, the estimates around gross bookings, adjusted net revenue, which is a variation on the revenue metric, and adjusted EBITDA, which is their profitability metric, they make no further commitments given the uncertainty in the world. So that was announced on April 16, and April 16 they also had some preliminary first quarter financial items. Basically what they did on April 16 is to announce that some investments they have in other entities where they have less than 50% shareholdership, so non-consolidated equity investments, they would record an impairment of between 1.9 and 2.2 billion. So a big part of the news and a big hopefully one-time impact on their financial results was already announced 3 weeks before the Q1 announcement. So that's also important to follow in case you have any shares in Uber or are interested in the company's performance. And by the way, just as a disclosure, I don't own shares in Uber. I have no positions, nor do I plan to take any equity positions. And I hardly ever use their services as I'm in a country with excellent public transportation. So that's just some upfront disclosure. So the earnings release, still quite a bit of news, but the impairment on the investments was already announced 3 weeks ago. And you might have also read that earlier this week, a big announcement was made regarding headcount reduction. And that is obviously also disclosed in the 10Q, the official filing. On May 6th, the company announced plan to reduce operating expenses, basically meaning they stop hiring and they lay off 3,700 people, or the full-time equivalent of 3,700 people. So in the middle of April, the announcement of the impairment on the investments in subsidiaries, equity investments. May 6th, 1 day before the earnings announcement, the announcement of layoff, to show that they're taking action to, let's say, align the organizational structure to the new reality in the pandemic. So those are important things to know before you even dive into the current quarter numbers. The other thing I'd like to remind you of is it's always good to see the context, especially with a company that's only been on the stock market for a year. This is the 10K, the official annual report that they filed after the end of 2019. And just to get a feeling for the size of the numbers, we can take a look at item 8, financial statements and supplementary data. And we can take a quick look at the past couple of years. This is the consolidated statements of operations or income statement. And the thing with Uber is they go from left to right. So the oldest year is on the left, the newest year is on the right. So be very careful with that one, because the habit of many other companies is to have the latest year on the left and the oldest year on the right. With Uber, it's oldest year on the left, latest year on the right. So that's purely cosmetic, but make sure that you're looking at the right column. So the story of Uber 2017 to 2019, they grew revenue per US GAAP from 8 billion to 14 billion. Loss from operations, this is what other companies would call operating income, but you can only report an income if it's a plus, right? You report an operating loss if it's a negative number. It dropped from -4 to -9. So while revenue is growing by 6 billion, the operating loss is growing by 4.5 billion, 17 to 19. And the net income loss used to be 4 billion, then went to positive 1 billion in 2018 and was negative 8.5 billion. This year was really an unusual because they made a one-time gain on sale of subsidiaries of companies that used to be part of the Uber group and are no longer in there. So that was an other income one-time gain in here rather than operational results. So net income, it's always a bit tricky because it includes many more line items than operating income. Operating income tends to be an excellent level to review, and while revenue has been growing for Uber, operating loss has also been growing in the wrong direction. It's become more and more negative. So that's just a little bit of context to get a feeling for the size of the numbers. Then for Uber, I approach the quarterly results analysis in a different way than with other companies. What you have seen if you attended the previous webinars with Netflix and Procter & Gamble and Facebook and Apple is that normally I start with the press release. After that, I tend to go to the presentation that they give to the stock market analysts. Then I might go through some balance sheet, income statement data, and only then do I get to the 10Q. With Uber, because they have such a specific business model and they're also quite eccentric in the way they present their financial statements, because they have a lot of non-GAAP metrics that they find important, that are not necessarily the same, calculated in the same way as other companies would do it. So what I'd like to do is to start from a known starting point. In a 10Q, if you report to the United States Securities and Exchange Commission, you have to report per the official accounting rules, per official US GAAP, US generally accepted accounting principles. So it's easier to start with what we know in order to be able to compare to other companies and in order to comply with the regular principles and rules of accounting. And then we go to Uber's version of what they think you should know about the company. So bear with me, we first go through the 10Q and then through the company's own results disclosure. 10Q, what's interesting to note is that it's 132 pages for Uber. So if you really want to do this properly and read it from start to finish, it's quite a lot of reading. Then again, there's also obviously some pages at the end, starting with page 100, that is purely signatures and disclosures and, let's say, formalities. So you don't really have to read all 132, but the size of the file also gives an indication of the complexity of the company. For example, if you look at Apple, which we discussed in the previous webinar, their 10Q, and the 10Q is the official quarterly filing with the SEC, is only 43 pages. So Apple, one of the biggest companies in the world in terms of market capitalization, revenue, profitability, and cash flow, they can give you a quarterly update in 43 pages. Uber needs 132 pages. So that's also an indication for how complex this business is and how much there is to tell. What's very important with Uber, given that they've only been on the stock market for a year and that they've never in their history made a profit, is the section on risk factors. It starts on page 61 and ends at page 98. So 37 pages of risk factors. So if you are thinking about investing in Uber or are an existing shareholder, which I'm not, once again, disclosure, it's very wise to read the risk factors. And these risk factors are the ones that the company itself indicated and would like you to be aware of. Obviously, you could also go external and you could go to, for example, Wikipedia. Not that Wikipedia is always objective, but it's at least outside of the Uber Corporation. This is a list of criticisms that Uber has had on their business model, their ethics, the way they deal with their partners, the way they deal with, let's say, tax regulations, the way they deal with items in the news, CEO behavior. I'm not going to go through all 22 of these items, but these are good to read before you invest or make any investment related decision. If you look at the ones that Uber lists for you, obviously coronavirus, COVID-19, has a very significant impact. I listened for 15 minutes to part of the earnings release call that the CEO and CFO of Uber had with stock market analysts, and they talked about 80% decline, so 80% decline April 2020 versus April 2019. So whereas Q1 only had, let's say, 3 weeks in the US and Europe, pretty much 3 weeks of COVID-19 impact, April obviously had a full month impact. So that's a big major risk. Then other risks with the company are, for example, if you scroll down, we have incurred significant losses since inception, we being Uber, and our operating expenses are increasing. We may not achieve profitability. So they are warning you that they are currently unprofitable, have always been unprofitable, and may never get profitable. So Not profitable yet isn't necessarily a problem, right? They could turn the corner, but never profitable would be a problem, especially because you also cannot compensate any future gains or income with historical losses, and you would lose your tax carry forward. So this is an interesting section. There's also a controversy whether drivers are employees or, let's say, independent contractors slash entrepreneurs. There's lots and lots of risks with this business. There's obviously large opportunity, right? If they make it, they could make it very big, but they have had problems with their reputation. They have had legal cases. They have had a lot of criticism along the way. So it's very good to be aware of that, which is non-financial information. It's qualitative rather than quantitative, but it should be a major factor in you um, if you think about investing in this company. So let's go to the financials, because after all, this is a Finance Storyteller webinar. Let's go to the statement of operations, the income statement. 2019 Q1, $3.1 billion in revenue. 2020 Q1, 3.5 billion. So despite the difficult circumstances and despite challenges, the company once again has grown revenue year over year, which is obviously a very important metric for a company. We've seen other examples of Apple struggling to grow revenue, only having 1% revenue growth, Q1 versus Q1. Facebook, solid revenue growth, I think it was around between 15 and 20%. And then Netflix, if I'm correct, was around 28%. So that is definitely one of the key metrics that is being monitored by shareholders as well as analysts. Loss from operations was 1 billion last year, 1.3 billion this year, and that is just one quarter. So if that's the run rate, and there are 4 quarters to go, it could be as bad as 5 billion for the year. So yeah, that's definitely something to be aware of, that revenue is increasing while losses are also increasing in the negative direction, so the losses are becoming bigger. Then we scroll further down and we go to the net loss attributable to Uber, which is your basic negative net income number. That went from 1 billion negative to 2.9 billion back negative, mostly driven by other income. And this is the number that I told you about earlier with the April 16 announcement. If we go back to the press release here, they talked on April 16 about preliminary first quarter financial items. And they already warned us several weeks ago that given that the world is currently on some form of lockdown, we expect impairment charges on the minority equity investments. And then they mentioned the number somewhere between 1.9 and 2.2 billion. So that fear has become a reality with a write-off of 1.8 billion over here. So this, hopefully, banking can be considered a one-time item unless things get far worse and they have to do further write-offs in the future. So if we do a quick search for other income, we might be able to get some color on that one. Yeah, downward adjustments including impairment. These primarily relate to its investment in a company called Didi. And until today, I had never heard of this company before, but this has to do with the activities in China that Uber has divested. And in return for divesting those activities, they got shares in Didi. So if we look at Didi in the search, then we should be getting a valuation on that one. Okay, here we go. Yeah, so total investments, and these are subsidiaries of Uber that are not consolidated because they don't control those subsidiaries. For more information on that, see my video around consolidated financial statements. Didi, if we look at the balance of 8.7 billion at the end of Q1, 6.2 of the 8.7 is Didi. And it used to be worth 8 billion in the books of Uber. It's now worth 6.2 or 6.3. So that's the major decline over there. And then in the footnote, and some people will recognize that footnotes are sometimes more interesting than the main reading. In 2016, the company completed the sale of Uber China to Didi, and in return they received 52 million shares in Didi's preferred stock, which at the time was worth 6 billion. Okay, so back to the income statement. There is part of the results are ongoing, right? Revenue is a recurring thing every quarter. The loss from operations, once again, just like we've seen in going from 17 to 18 to 19, the loss from operations from over the years has become bigger. It once again became bigger year over year. And then this one was a one-time item, so net income, in my opinion, is a less meaningful metric to compare. If you compare 2.9 to 1.1, that's less meaningful than this one, because the loss from operations is a more, let's say, ongoing metric. As I said, unless this repeats and the valuation of that shareholdership in the subsidiary Didi continues to decline and decline. So some positives, some negatives for the company. Revenue growth is always a good thing, especially in challenging times. Then again, on the earnings call, they mentioned that April 2020 to April 2019 is down 80%. So much of this revenue increase must have come from the earlier months of Q1. Spending has increased because cost and expenses went from 4.1 to 4.8. With the headcount reduction that they have announced, that should be most likely partly reversed. There could be one-time restructuring charges related to it. So lots of, let's say, negative news that we already expected. If we look at the other financial statements, let's go back a little bit to the balance sheet. Uber has $8 billion in cash left. And on top of that, 831 million of short-term investments that should be highly liquid and they could be able to sell. So $8 to $9 billion of firing power, of money they have available to keep expanding, to keep doing capital expenditures, to pay salaries of employees, to pay for marketing events. They do have an ample amount of liquidity for the upcoming quarters. Another check on that one is to test my current assets of 11.1 against my current liabilities of 6.6. That's called the current ratio. If we take a look at that one, that is very healthy if that's above 1, and it's 1.7. So for every dollar of current liabilities, things that you have to pay in cash within a year, we have $1.68 of current assets. Things that are already cash or should become cash within a year. So from liquidity perspective, even though the company is unprofitable and has been since its inception, they still have plenty of cash available in order to keep operating. If we look at the rest of the balance sheet, obviously, if you're a loss-making company, your equity from year-end, 14.9 billion, due to the loss from operations, which is this number, goes down. Equity is the book value of the shareholder capital. Equity grows if you are profitable and don't pay a dividend or don't buy back shares. Your equity grows. Equity declines if you are unprofitable and you make a loss, and the loss gets added to the equity balance. So 12 billion in equity left. That's quite a lot of money to, let's say, burn through before you are back to zero equity balance. Let's take a look at cash flow next. If we look at the cash flow statement, which is a bit further down, we found that cash from, where is my number here? Cash from operating activities, so what the company receives in payments from customers minus what it pays to suppliers and employees. Cash from operations is negative, so more cash is going out of the business than coming into the business, which is, I guess, inherent to the stage that the company is in. On top of that, there is a cash flow outflow from investing, from purchases of property and equipment, which other companies might be calling capital expenditures. And this number of 463 plus this number of 198 together, that's your free cash flow. And free cash flow is a key metric to look at the overall performance of a company, because free cash flow is that amount of cash flow that doesn't need to be reinvested in the company and that isn't needed for daily operations or investments. So free cash flow is the amount of money you could take out of the business without hurting it. And as we saw with Apple and Facebook are generating a lot of free cash flow, and as a result of that, are able to afford paying a dividend, which Apple does and Facebook doesn't, and or buy back shares, which Apple does to a great extent and Facebook does to a lesser extent. Uber has negative free cash flow, so that means you are burning cash, and you're burning cash. So that's not a good thing, and the valuation of Uber is basically based on people hoping or dreaming or believing that somewhere in the distant future, Uber will first become profitable and second of all become cash positive, because in theory the valuation of a company is the discounted number of the future free cash flows. At the moment the free cash flow is zero, so that would mean if you look at just this quarter's free cash flow, that the company is not worth anything because the free cash flow is negative. Obviously, a valuation of a company depends on today's performance as well as estimations of the future. So that's a bit of color around that one. Then let me show a couple of more things before we jump into Q&A. Let me go. This is an excellent presentation that the company published with what they find are their key metrics. A key number for them is gross bookings. And gross bookings, that's a total spend of customers on Uber rides and Uber meals. So the Uber system in total, Uber itself, plus the drivers and restaurants that work with Uber in that, let's say, network, together they generated gross bookings, total combined revenue of that whole ecosystem as a whole, of 15.8 billion. And that same number last year was also 15.8, but part of that is driven by currency. So let's see how that works. I actually don't have that reconciliation right here, but what Uber tells us is that in constant currency, gross bookings are up 10%. And we'll have to go to the notes to analyze that in more detail. Obviously, in the past, those growth numbers were way more impressive, right? They used to have 40 to 40%. So 10% definitely indicates the COVID-19 pandemic impact already in a couple of weeks. And Q2, April to April, as they said in the conference call, it was down 80%. Adjusted net revenue, so gross revenue is for the ecosystem, 15.8. The take of Uber Corporation, what they call adjusted net revenue, they get 20% of the total amount that the customer pays. So 80% goes to the driver and the restaurants and all the other people that get a commission in this whole game. 20% goes to Uber, so their revenue is 3.2 based on an adjusted basis. And that used to be 2.9 last year. So that's their version of the truth. And then EBITDA. EBITDA is a non-GAAP metric, so it's not an official SEC approved metric. And what's even worse, that this is adjusted EBITDA. So if you've seen my EBITDA videos, you're probably familiar with this definition. EBITDA is earnings before interest, taxes, depreciation and amortization. So in sectors like telecom and other highly capital shipping, for example, as well. Highly capital intensive companies, or companies that have done a lot of acquisitions in the past, leading to amortization of intangible assets. A lot of companies, for example, in telecom or in high-tech sectors, talk about EBITDA or EBITDA when they try to exclude those depreciation charges or the amortization from their ongoing performance metric. And as long as everybody does that in the industry, and you can still compare, let's say, pairs to pairs rather than apples to apples, you have some comparative metric. The SEC, as well as the board of the International Accounting Standards, is not very happy with EBITDA because it's not a officially defined metric. It gets even worse if you get to adjusted EBITDA, because adjusted EBITDA means that the company itself sees reason to take certain expenses out of the metric. So if you look for adjusted EBITDA in the press release, adjusted EBITDA, you will find a definition of adjusted EBITDA further down. Sorry, I'm in the wrong section. I should be doing that same thing over here. So adjusted EBITDA, somewhere we get to a definition, right? After it's being used many times. And this is the digging that I like to do, right? Figuring out what's below this. So non-GAAP metrics become more suspicious. I'm not saying something is wrong, but I'm at least a little bit worried if, first of all, there are a lot of line items, and second of all, if the adjustment amount is big. So adjusted EBITDA is net income, excluding income from discontinued operations, excluding non-controlling interest, excluding income tax, including income or loss from equity method investment, including inventory expense. Most companies that report EBITDA exclude these 5 items. Then adjusted EBITDA, the word adjust relates to these other items that Uber by itself finds that they shouldn't be part of what they are measured on. And as I said, the longer the list of items and the bigger the financial impact of those items, the more worried I get, because if you keep excluding more and more, it becomes earnings before bad stuff rather than a meaningful accounting metric. So adjusted EBITDA, even after adjusting and cleaning up their profitability metric, is still a negative number. It was 869 million negative last year. It's 612 million negative this year. So it's not as bad as it used to be. But pretty much they make, even after cleaning up the numbers, they make a 20% negative operating margin after adjustments. So Uber, despite its enormous potential, and they could become a very dominant player, they are far, far away from profitability. They are far away from profitability on a GAAP basis as well as a non-GAAP basis. Last point I want to make on this one is it's always good to be aware of the SEC regulations, even though the language is quite complicated sometimes. The SEC has stated when a registrant, so a company that's filing financial statements that is officially listed, if you're a publicly listed company, you must present non-GAAP measures alongside comparable GAAP measures, and the GAAP measures have to be with equal or greater prominence. So GAAP goes before non-GAAP, and in typical US GAAP fashion, for example, the font size of the GAAP numbers and the placing in the earnings release has to be before the non-GAAP. And this is where I think that Uber is either on the line or crossing the line. Because if you look at the press release of Uber, the first things they talk about is revenue, which is fine, that's a GAAP metric, right? It has grown. The second thing they mention is rides adjusted EBITDA was 581. So before mentioning profitability per the official GAAP numbers, they start focusing on one division. It's obviously the biggest division, but not the whole corporation, right? The whole corporation's EBITDA is negative, right? whereas the rights division is positive. Plus, it's a non-GAAP metric presented before a GAAP metric. And the SEC has told you, thou shalt not present non-GAAP before GAAP. So what I found in summary, before I take some questions, is Uber has a turbulent history of making losses and having controversial, let's say, disputes and legal cases. They have a lot of non-GAAP metrics. They are growing in revenue. They are more and more loss-making. They have negative free cash flow. And I think one of the most positive things I can say about the company on page 15 of this presentation is they still have lots of cash to burn. They have $9 billion in liquidity between cash and short-term investments. And if worse comes to worse, they could always sell those in minority investments that at the moment are worth 10 billion. And those are the investments in Didi, Grab and Yandex. They also have a revolving loan that they could draw from of 2 billion. So in summary, quick summary from my side, Q1 still growing in revenue, loss making and the loss becoming bigger. Q2 revenue is going to be dramatic because it's going to be significantly down versus last year, depending obviously also on when certain countries are loosening the COVID-19 measurements. Cash flow is negative and is, let's say, increasingly negative every year. Liquidity, I don't see any short-term risk. It looks like they have plenty of cash available to keep operating for a while. And in these uncertain times, that's the first thing I would check. And the first thing, if I was a Uber investor, I would be worried about. So difficult to analyze, but lots of things to learn and a very interesting company. My key takeaways for Uber: beware of non-GAAP metrics, be aware of what is or isn't an officially approved and blessed GAAP or non-GAAP metric. My preference, I always review GAAP metrics first before non-GAAP metrics, because non-GAAP can be way more exotic. Always watch announcements in the weeks prior to the results announcement. Right? If you watch the news carefully, you already heard of this big write-off in the equity investment. You already heard of the layoff of the workforce. You already heard of the discontinuation of Uber Eats in 8 smaller countries. So those are not totally new items anymore in the earnings release. And then, as I showed you, risk factor section can be extremely interesting. As I said, it is actually the majority of the number of pages, right? From 61 to 98, 1/3 of the relevant section of the quarterly earnings release is qualitative risk factor discussion. So that's most of what I can tell you about Uber. Let me put the income statement back up here for reference, and let me look at the chat window to see what has been going on. Okay, reading the footnotes is an art. Yes, footnotes are extremely important. Does Uber report per country? That's an excellent one. Geography, let's type that one in. Thank you, Anna, for that question. Here we go. The revenue of 3.5 billion was 2 billion in the US and 1.6 billion in other countries. And we can even get more detail by region. Let me check again which note they wanted to check. Note 2, revenue. Okay, why don't we go to note 2 then? And the big... Here we go. Yeah. This is a very good one. Thank you very much. Out of 3.5 billion in revenue by business, 2.5 out of 3.5 was driven by rides, right? People taking rides with an Uber driver, right? So that gives you an indication of what is 2470 divided by 3543. 70% of the revenue is driven by drivers. Then Uber Eats is the second largest, and then freight is smaller. By geography, So I can do the cut by business, right? Rides and other divisions. I can also do it by geography. US and Canada, 2.1 billion. Latin America, $500 million. Europe, Middle East, Africa, $500 million. That might change in the future, obviously, given the announcement that Uber has, in the Middle East, has acquired Careem Corporation for $3.1 billion. That deal was closed very early in January, just after the start of the year. And until very recently, the big expectation of growth would be coming mostly from Europe, because Uber was announcing that they would be hiring a lot of new people and moving to bigger offices in order to accommodate the growth of the sales, marketing, general administrative staff in Europe. And what we've seen recently is that they now announce layoffs, and that probably a lot of the hiring plans are on ice, they are frozen. Asia Pacific is 352. Part of that is that this is primarily Australia driven. And as we saw earlier, Uber used to be operating in China, but then they sold that China business in return for getting shares in Didi Corporation. So indirectly, they're still active in China, but through a equity investment in a subsidiary rather than directly. So this is kind of a little bit, it's not misleading, but it's a little bit difficult to place into context, because this 3.5 billion in revenue is obviously only the direct revenue that immediately comes into the Uber Corporation. And remember, this revenue is 20% of what the consumers are spending when they place an order with an Uber driver or with an Uber restaurant. Okay, so those are two ways to look at that number, and this also tells me that to a large extent Uber is very dependent on if and when the US will open up the pandemic measures. Okay, what else would you like to know? Yeah, is Uber becoming more a global taxi company? I really don't know. I don't know the company well enough to say that. I do know that they have had a very charismatic early CEO that got replaced a couple of years. SoftBank is their major shareholder. Alphabet Inc., the parent company of Google, apparently also has a 5% shareholderships. And the IPO, as I said, and please watch my What is an IPO video. The IPO was a big disappointment, right? First day down, second day down, whereas some other companies had a big increase on day one of the IPO. So Uber got a lot of negative press because of their business model, because of the not so successful IPO. I don't know. I'm not sure. I mean, the app and the system and the structure and the technology, the innovation definitely has value. But will it create profitability and cash flow anytime soon? That was already a difficult question before the COVID-19 pandemic, let alone in today's economy. So this is definitely a company that's hit hard by uncertainty. Strangely enough, if you look at the share price, there are still believers in Uber, right? If you look at the 1 year, they went to the stock market in the IPO for 45, they're now back at $33. And if you look at the past month, it's up all the way, right? I mean, Wednesday, $28, and they announced the earnings and they lay off people and they're at 33. So within a week, you can go from 27, 28 back to 33. So apparently, people saw, or on average, the investors saw a reason to buy this week, despite layoffs, or maybe because layoffs, and despite the numbers. But then again, much of the bad news was already released on April 16 rather than during this week. So it's also about timing. Year to date, if you look at Uber, started the year at 31. and today they're at 33. We could also take a look at a major competitor. Let's take a look at Lyft, for example. If we look at year to date, Uber is up 5% versus January 1st, which is obviously an arbitrary time point, but since the start of the year they're up, and Lyft is down 24%. One possible reason for it, but then I go into the realm of anecdotes and speculation, is that Uber is heavily investing in the Eats business, and the Eats business is obviously actually benefiting from the pandemic because more people are getting a delivery of food rather than taking a ride themselves. Let's see if we have any. Where was that data? Eats. No, this is just EBITDA. Let's see if we have some more data on Eats. And as you see, I sometimes improvise these just to get some things going here. Okay, I don't have the answer for you here. But remember, Uber is both a transport company with the app and the transportation opportunity, as well. It's also a food delivery and, let's say, delivery of other items company, where, as far as I know, Lyft is more a pure play transport company, where it's a taxi replacement. So that might be one of the reasons. Or if we really want to do a comparative analysis, maybe Lyft is even harder hurt, or maybe their numbers were even worse. We could even check when Lyft earnings were released. See, you always get up with more work, right? Yeah, they also released earnings this week. So, oh, this news site is saying that because the CEO of Uber has said that the ride volume is increasing again after the 80% decline, investors are optimistic. So I was shocked by the 80% decline, and other people that have invested in Uber are optimistic because week by week things seem to be not as bad as before. Right? So that's kind of the second derivative of growth. Let's take a look at the past 3 months. Yeah, it looks like, yeah, we really have to go back in time if we want to have a conclusive answer to that, because all year, even before COVID-19 started, it seems that since February Uber has outperformed Lyft. So if we really wanted to know the answer, we should look at the Q4 earnings release, which was early February, where we received the number of 2019. So that might be a bit of an unfair comparison. And that's also one of the learnings of going into earnings releases. When I start analyzing Uber, I start with the investor relations website and look through the press release. Then I found out that the 10Q is interesting, which is the quarterly earnings release. Then I go back in time to the 10K to see the longer term annual perspective. Then I start looking at websites to find any acquisition related data. I go to news items. In a way, it could be a snowball. Once you start analyzing a company, you could end your analysis with more question than you started with, because there's always more doors that you open and more avenues that you could explore. So I hope this was helpful. Learnings from this analysis, GAAP versus non-GAAP. Look at the earnings release as well as the other announcements that come out from a company, and definitely, especially with early stage companies that have not shown their performance yet as an established company. With Apple, I mean, those guys have been around, they've weathered storms before, so I'm not as worried about the risk factors. And actually Apple in their earnings release said, hey, for risk factors, this is the one item that we want to add, and for the rest, just go back to the annual report. Whereas Uber makes a big effort to describe specific items each and every quarter, given that they are younger and therefore less established. So those were some learnings. I encourage you to take a look as well at the other live streams, and for any questions, I'm always available. So hope to talk to you again in the next webinars. If you have any suggestions or questions, let me know. And I'm working very hard on some new videos and have 2 video updates on very new and different topics for you this week. So exciting times. I hope you enjoyed this whole series of webinars. I think this is going to be the last one about Q1 financials, unless something very exciting comes up in the next couple of days. And that has happened before. I have been positively or negatively surprised by some of the financial news recently. So if something happens, we could always schedule the next call. Okay, thanks very much for your questions and your interest. It was good to see so many people here on the webinar, and the webinar is available for replay as well if you want to see any specific parts again.